Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 241 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need from the past week in the world of financial markets and financial planning. So great to have you back on, Matt. It's been quite some time, but it's good to see your face again.
I'm pumped. I had so much content, it was hard for me to bring it down to a level that was going to be acceptable for time.
Yeah, I saw that. It's like your first item, you had like 3 or 4 things in the first one. So
it's going to be a blitz, baby. Get ready, everyone.
Y'all have. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on February 28th. S&P 500 index up 4.6% for the month of February and up 6.3% for the year. The Dow Jones Industrial Average up 2.1% for the month, up 3.3% for the year. The NASDAQ Composite Index up 5.2% for the month and up 6.2% for the year. The Russell 2000 Small Cap Index up 4.9% for the month and up 0.8% for the year. And the Vanguard All World Ex United States ETF up 2.9% for the month and up 1.2% for the year. 3-month Treasury rate at 5.45%, the 2-year Treasury rate at 4.64%, and the 10-year Treasury rate sitting at 4.27%. So yields come back up a little bit, Matt, as expectations for the Fed to cut rates keeps getting pushed out. So it's going to be interesting to see what happens on the yield standpoint as the Fed pushes rate cuts out farther and farther. And I've already seen data come out that the average 30-year mortgage is back around 7%, or getting close to it, which obviously is a negative for home buyers or people in the market for new homes. So it just has a lot of little ripples throughout the economy.
I have a piece. I'm going to talk about the historical pace of interest rate cuts and what that means for risk assets. I think our listeners and viewers are going to eat it up.
All right. Well, I will leave it at that and wait to hear what you have to say on that. But big headlines, current events from this week. Congress struck a deal to keep the government funded before Friday, tomorrow, March 1st. They extended the deadline, long-term deadlines, until March 8th and March 22nd. The House and the Senate still needs to formally pass this measure prior to Friday, which is expected. Kind of a nothing burger for stocks, but definitely something in the media that has been talked about for quite some time. Another thing, Matt, which I find interesting is Nancy Pelosi is back at it again, buying calls in Palo Alto. Ticker symbol is PANW. And just to get it out there, I'm not just picking on Nancy. I'm picking on Nancy because she's the most well-known with this, right?
Yeah, she got a lot of notoriety.
Senators and congressmen and women, both on Republicans and Democrats, they do this, okay? So I'm not just picking on Nancy, but Nancy is just the most prominent, it seems like, of them. So 1.25 million in call options that expire in January of 2025 with a $200 strike price. So really quick, options 101. She bought $1.25 million of call options, which gives her the right to buy Palo Alto stock at some point in the future at $200 per share. Before January 2025 when these things expire. So right now I think Palo Alto is like 220, 230, Matt.
Yep.
So she bought calls on 2 separate occasions earlier in February prior to their earnings report, and then Palo Alto had a really bad stock reaction to earnings. It was down between 20 and 30% after earnings, and then it rocketed back up seemingly after it was announced that Nancy bought some calls. But The one thing I want to point out is from what I've read, and again, I cannot confirm this. It's just what the word on the street is, so this might be a rumor. But the purchases of these call options of Palo Alto was after the fact that Congress was briefed on a major cybersecurity threat to the U.S. over the next 6 to 9 months. Again, can't confirm or deny that that's true, not true, but just interesting in my opinion.
I love it. I eat this stuff up like candy. I love hearing about it. I love reading about it. I could go on for a while about this topic, but I think it's great you brought it up. And hey, there's nothing wrong with the public being aware of the only people in America that can trade legally on inside information.
Yeah, exactly. They put they put Martha Stewart away for insider trading, and I think it's no question that what some of the congressmen and women are doing is more egregious than what she did. So yeah, but and again, just to preface this to people who follow this, she's done really well on her NVIDIA calls. Doesn't mean the same thing needs to play out in this situation. There have been times where she's bought stuff and she's lost money on it, right? So it's not a situation where, she's right every single time. Her hit rate is pretty good, but we'll just have to wait and see. I'd be interested to see.
Her on base batting percentage is quite good.
Yeah, I'd be interested to see what these call options are worth, closer towards the end of this year or early next year. So might have to come back to that.
Love it.
First thing I had, Matt, was a blog post from Ben Carlson on February 11th titled, "How Often Do Bear Markets Occur?" So it's seemingly every year that everyone or someone is worried about a bear market. And just matter of fact is bear markets tend to not happen super close to each other, right? And I think Ben does a really good job explaining some of the data behind this. So he says there have only been 5 crashes in the 50% or worse range over the past 100 years. Crashes happen, but they're rare. It doesn't make sense to spend 100% of your time preparing for something that might happen 5% of the time. Bear markets and corrections happen far more often than a system-wide panic. Plenty of pundits think that we could be setting ourselves up for a bear market right now. Here's the thing though, we've already experienced 2 separate bear markets this decade.
Boom,
During the
boom.
COVID crash, the S&P 500 fell 34%. During the 2022 bear market, the S&P dropped 25%. That was 2 bear markets in the span of 3 years, which is pretty rare.
Rare.
If we had another bear market in 2024, that would be 3 in 5 years. Has that ever happened before? The US stock market has experienced a double-digit correction once every year and a half or so, and a bear market once every 4 years on average. We haven't seen back-to-back-to-back bear markets in a really long time, not since the Great Depression. Using history as a guide, you would have to assume the prospect of another bear market coming again in short order would be improbable. The counter to this argument would be that cycles are happening faster and faster these days, and because of technology and the speed of information. The least satisfying answer ever is I could see it both ways. So I thought this was really good. It kind of plays into the theme we've talked about, for years on this show, Matt, was that people spend too much time planning for the bad periods in the market, where the reality is 3 out of every 4 years the market is up. So, on average, tongue in cheek, market's up 75% of the time, right?
Yeah.
And we don't spend enough time planning for those good times. We're always just worried about that, that 25% of the time where it's not fun to be an investor, right?
Yep.
I do like his point though that that cycles are happening faster and faster because of technology and us having these devices at the tip of our fingers to be able to do pretty much anything we want at any point in time. So that is a consideration. So I'm not saying it can't happen, but I do agree with Ben that just looking back at the data, it is quite improbable that we're going to get another 20 to 30% flush over the next year or two.
I got so many follow-ups to this. I'll try to keep it very brief. The first is, my perception with the experience and the data I'm seeing is that people are still, for the most part, underinvested to risk assets post 2022. So the proximity of another major sell-off is low, in my opinion. The follow-up I have is with the speed of these cycles in technology. I see it to a certain extent, but also we do see a lot of similarities with the data with the past. And so maybe the sell-offs and recoveries are quicker, but I still see a lot of similarities in the way people behave, even though the information comes quicker. So I got other things, but for time savings, this could be, I could do a podcast just on this topic.
Yeah, maybe we'll do a special podcast based on bear markets, how often they happen, how bad they are, and what typically follows next. So,
and I prefer to do it when we're not in one, so people can have some perspective. Okay.
Yeah. Second thing I had was a tweet from Jeremy Schwartz on February 20th. Jenna will throw this up for YouTube viewers and in our show notes, but he says, with Amazon getting added to the Dow, is this a signpost of 2020 tech-inspired changes to the key gauge?
Good question.
Salesforce was added on August 31st of 2020 to replace ExxonMobil. He said, how did that work out? And there's a chart of ExxonMobil, Salesforce, and the Dow since Salesforce replaced ExxonMobil. And the funny thing here is ExxonMobil's up like over 200% since this change happened. Salesforce is only up a measly like 5-10%, and the Dow's up like a little over 80%. So it's pretty common, or at least the last couple major changes we've seen, Matt, in the S&P 500 in terms of holdings moving in and out, and for the Dow moving in and out.
Yeah.
The companies that get added to these major indices tend to not do so well over the coming years, and the companies that get removed, like it like marks the bottom, right? And these things just grow like gangbusters. And this is a perfect example with ExxonMobil, is that, in 2020 tech was obviously all the rage, and the powers that be obviously felt that ExxonMobil no longer represented a large enough or substantial enough portion of our economy. So they took it out. And then Exxon and energy in general went on a massive run, obviously, right?
Yep.
So again, past performance, not indicative of future returns. Do I think Amazon's reign is ending? No, I do not. But just something to be noteworthy. And the company that's coming out this time is Walgreens, which has been a serial underperformer for 5 to 7 years, if not longer. So it'd be interesting to track, Amazon and Walgreens going forward to see if this trend is something that continues.
I got a hot take. Get rid of the dogs of the Dow strategy. Just bring in a strategy that buys the one that's getting exited, shorts the one that comes in. It could be like a hedge fund version of dogs of the Dow.
Right.
I could just see someone listening to this podcast having the proper software to do the retracement of the historical returns of what I just said. We're going to get an email about this, right?
Right. Yeah, maybe Nick could put something together for us, because that would be interesting to see. So just something that's interesting. That change is happening here shortly. Last thing I had, Matt, was just a quick quote from John Neff. He's a legendary kind of value-oriented investor, and he says, "When you feel like bragging, it's probably time to sell." And we've gotten to this point so many times in so many different industries, and the big ones that come to mind is people bragging about crypto, people bragging about marijuana stocks, now people bragging about AI.
It was oil before that. Keep going down the list. Yep.
Yeah. So and I've felt it too. Like a lot of times I stop and look in the mirror, I'm like, things feel like really, really good right now, right? Like we got a lot of confidence, like things are going well, and that is usually like, okay, let's take a pause here and look at the broader picture and see if there's anything that we're missing, because we shouldn't feel elated, or you shouldn't have butterflies in your stomach when you're making investment decisions. It's not supposed to be this dopamine hit that so many people seek today. It's supposed to be about rational decision making that has a major effect on your future, your financial future. So thought that was a good quick hitter from John Neff that I just wanted to share.
Yeah, I think if the movements were more broad based, I'd feel more concerns of a toppiness per se, but that's not the case from the technicals.
Yeah.
All right. So big items, big market items. Since my last podcast appearance, I want to make sure I just threw out there for our listeners and viewers. They can hear it from the horse's mouth. First is it's an observation. Ready for this, Mark? You take NVIDIA's market cap, you take Microsoft's market cap. It's over $4.5 trillion. Do you know that Japan's entire economic GDP output is $4.9 trillion? In addition, do you know that NVIDIA added $1 trillion of market cap in 84 days? 84 days.
Crazy.
I want you to take that in for a second.
Shout out to Japan, though. Japan making new all-time highs for the first time in, what, 35 years, 36 years, something like that. What, it's 87, right? So
Yeah.
how long is that? Yeah.
Yeah.
I mean, that's a long time. And I
Yeah.
think everyone's, response is, well, if it could happen in Japan, it could happen in the US where, we don't make an all-time high for 40 years. And yes, I totally understand that. Again, improbable in my opinion, but there's a lot of other junk going on
Oh, yeah.
over there.
Always my favorite Japan analogy is everyone talks about the fiscal irresponsibility of the U.S. and our debt to GDP. Don't even get me started. Okay. Japan is at like 240% debt to GDP. So I don't want to hear the people telling me that we can't afford, deficit spending. Am I happy about it? No. But don't sit there and try to lecture me about that.
Yeah. Yeah.
Starting to get on my soapbox. All right. So we talked about the Amazon and the Dow news. Other thing is equity inflows over the past 5 weeks have totaled $75 billion. That's the strongest in 2 years, according to Deutsche Bank on February 26th. Okay, here we go. First piece, small cap underperformance. This is a post by our friend Seth Golden on February 14th. Seth had this piece. Jenna's going to put this up for our YouTube viewers. Mark, this is going to be in our show notes. What it's illustrating here is that we are on the 4th longest streak for the Russell 2000 small cap indexer that you highlight in our pricing at the top of the podcast without a new high. And I'm illustrating this. I'm talking about this because the performance disparity between large size stocks, let's just throw in the example of the S&P 500 indexer and the Russell 2000 small cap index, there's a big disparity right now between performance. Could this performance disparity continue? Yes, look at the data. You had a period back in the early 2000s where it went 1,177 consecutive trading days where the Russell didn't make a new high. Right now, we're at 567. Could it go longer? Yes. But look at the data set here. We're at a period where, as a listener, I'd start to kind of get a little more sensitive to what's going on in small caps because the underperformance disparity has been so long and consistent. You might want to think about that.
Yeah.
Next, any comments before I move?
No, I just think if small caps do get going, watch out. That could move things quite substantially higher if everything's participating and not just a handful of names like was said in 2023.
Well said. All right, my next piece. I can't wait to see your reaction to this. So my topic of this for our listeners and viewers is future pricing model is going to be different for industries going forward. Here's the post. There is a trader, Gergavin, got 373,000 X followers. He posted this. Wendy's is planning to start an AI-based dynamic pricing system, just like Uber, where food item prices will change throughout the day based upon demand, time of day, and other factors. So, for example, everyone's going to that drive-through at noon. They want their Baconator, Mark. That Baconator might be $7 or $8, but if you win at 11.15, that bad boy might be $5.50. Okay.
Right.
Just take a step back. I want Mark's raw comment on this.
Yeah, it's interesting because obviously Uber does this with surge pricing, and there's like there's bars all over the country that have like a similar, like it's like a stock market based bar, right? So if like a beer is in really high demand, that beer is going to be more expensive than other beers, right? And it, the beer market crashes every so often, and you can buy beer at cheaper prices and that type of thing. But I don't know. This is going to be interesting to see if more companies start doing this. I mean, I think you could argue that this is already being done, like, using the supply chain, for example, like, take the trucking industry. Obviously, if there's more demand to ship goods across the country, trucking companies are going to raise their rates. I don't think that's any secret, but I think it's going to be more algorithmic, and there's going to be, AI that just determines what the price is, instead of us having to do that manually, or having a board have to get together, or the C-suite get together and say, hey, do we have to raise prices? Do we have to lower prices? It's going to be automatically done. But kind of funny that it's Wendy's that's,
Getting ahead of this trend?
yeah, getting ahead of this trend.
All right, so think about other industries where this could go into effect. And the other hot take I have is how long before it starts to affect labor rates? Could you imagine a situation where it's like, hey, as a staff member, you're paid less to work during the week and more on the weekends? Think
Mhm.
about that for a second.
Yeah, that's a good point. It's a good point.
So you could start to
Certainly could go in that direction.
see, yeah, with technology, it's a lot easier to implement and track these things. So I'm sure this is a topic that's going to be coming more and more in the future. I could just see us 3 years down the road joking, remember that time when I talked about Wendy's in February of 24? I'm going to say it, it's going to happen.
Yeah.
All right, so my next piece is what you alluded to, Mark, in regards of the pace of interest rate potential cuts by the Fed. So this is a piece that was posted by the Daily Chart Book. This was posted on February 12th. Jenna will put up this image for our YouTube viewers. I would highly recommend that our traditional podcast listeners look at our show notes and all of our social media sites. What you're going to see is a piece from Ned Davis Research that shows, quote, slow pace of rate cuts have been bullish for stocks. What you're going to see is two dramatic things on this chart. One, what tends to happen to the S&P 500 index, Mark, after the first Fed cut, and then it shows a slower cutting cycle versus a faster cutting cycle. And you know what you're going to find? The S&P performed better in slower cutting cycles. Now you take a step back, tends to make sense, because when you think about it, when the Fed is lowering interest rates, listeners and viewers, they are doing it to incentivize and stimulate the economy. They're making the cost of capital cheaper. Okay, so when that happens and they're more aggressive in doing it, what is that telling you about the underlying strength of the economy? It's telling you that they're trying to push more medicine into that patient to heal it, to get it going. And that's a warning sign. So I think, Mark, coming full circle, if you start to see continued economic strength, you could see a slower pace of interest rate cuts when that first one happens. And guess what? That's not bearish. When you look at history.
Yeah, I think it's, one of the things that we look at, in our investment committee meeting is, when the Fed pivots, and starts cutting, what's the performance of the markets? And the past two times obviously have been, or the two major times have been, the tech bubble and the great financial crisis, right? And COVID. And in all three of those instances, those were really fast cuts. That's like, oh shit, we have a problem. The economy has a problem. We need to cut rates to close to zero to stimulate the economy. And that always just throws things into a tizzy, right?
Yep.
So, but if you look back to the 50s, the 60s, 70s, and 80s, there have been slower cuts. So it's going to be interesting. And the market has done fine, it looks like, right? So
Yep.
I think it really depends. And no one knows, right? We could have another event where the Fed's like, oh my gosh, we got to cut rates to 1%, right? And I think that would be a really bad thing for the long term. So I think everyone's hoping that, hey, we're going to gradually lower rates back to this 2 to 3% range over a 2-year period. I could get on board with that. So I think, like anything else, a shock to the system isn't a good thing. Slow, gradual change, like anything, is better.
Absolutely. Well, I had so much content. I'm going to have a lot more next week. It was really tough to go through. My final comments before you transition to the financial planning topic of the week, Mark, I just kind of want to throw out there is just kind of know where we're at with the calendar. Today's February 29th. We're in a leap year. I saw some data that for strategies that rebalance on a monthly basis, you have another month of strong equity performance. You might see some stock weakness as people rebalance or do some selling pressure here of equities the first couple business days of March, just like you saw at the very beginning of January after that strong December. I'm going to be very curious to see how the market treats any sort of sell-off. You got a lot of people on the sidelines, cash just in their fist, waiting for some entry points, and I'm curious to see how the psyche at Wall Street is. Are they going to be putting that cash to work relatively quickly? Are they going to have quote unquote iron fist, or are they going to get spooked by kind of the next correction? So I'll be very interested how that goes, and I'll definitely be sharing my thoughts and comments on the podcast in the months and weeks to come.
I appreciate it. Thanks for the good content, and looking forward to having you back a little more regularly over the next couple months.
Thanks, partner. All right,
All
I'll
right.
turn it back to you.
All right, so Taylor Ledbetter coming back onto the podcast this week to talk about our financial planning topic of the week. This topic is going to surround early withdrawal rules and penalties for individual retirement accounts or IRAs. So there are different rules based on certain account types that you have, and there are certain exceptions in certain areas if you want to retire early, for example, before age 59 and a half. But I want to kind of turn this over to Taylor to dig into this a bit more because it can get quite confusing, especially with some changes to the tax code over the past couple of years. So Taylor, thanks for coming back on.
Yeah, it's good to be back. So yeah, just going off what you said, I wanted to focus on the different penalty rules specifically for the traditional versus the Roth because they are taxed differently. So we're going to touch on that. But yeah, like you just said, these penalties do depend on a few different factors. Number one is going to be the account type. If it's a traditional or a Roth, because that 10% early withdrawal penalty, the amount you would actually pay would be different from a traditional versus a Roth. Second, you normally have to be 59 and a half to withdraw funds, or you do incur that 10% penalty. And really the only way to get around that age limit is if you do qualify for an exception, which we will cover here in a couple of minutes.
Right, and that 10% penalty, Taylor, is in addition to the taxes that you would have to pay if it's coming out of a traditional IRA, for example.
Correct.
Yeah,
Mm-hmm.
because that's all taxed at ordinary income. So you have the ordinary income tax in addition to a 10% penalty. So it starts to add up pretty quickly, especially if you have a large balance in that 401k or IRA.
Oh, definitely. Yeah, and that early penalty applying to the whole amount, it does apply to all pre-tax accounts. So, like you said, the traditional IRA, 401k, SEP IRAs, rollovers, because again, they're all in that same tax bucket. So if you do withdraw money before you're 59 and a half and you don't qualify for one of those exceptions, you could be paying, 30% or more in taxes.
Right.
And a funky rule, I don't think this is talked about very often, is that simple IRAs actually have a different penalty amount. So if you withdraw money from a simple IRA within the first 2 years of participating in your plan, that penalty is actually 25% instead of 10%.
Yeah, so that's definitely a big no-no, right?
Yeah, it's a pretty big difference.
Yeah. So, yeah, and again, simple IRA is a little bit more common at smaller employers. So if you do fall in that camp, definitely make sure you understand the consequences of that, because 25% is a big number for a penalty.
Yeah, that's 1/4 of the account,
Yeah.
basically.
Yeah.
So Roth IRAs, again, those are subject to the 10% penalty, but since Roth contributions are made with after-tax dollars, that penalty and the tax you would pay only applies to the growth on the account, not your contributions. Because Roth IRA contributions, they are accessible at any time for any purpose because, again, they've already been taxed. But still, that minimum age requirement applies. And another rule specifically for Roth accounts is that the contributions have to stay in the account for, or sorry, your contributions plus the growth. There's a 5-year holding period to avoid that 10% penalty.
Right. So that's the thing. I just had a situation come up earlier this week where a client was like, "Hey, should I be contributing to a Roth?" And it's like, well, you're getting close to that retirement age, and this individual does not have a Roth IRA right now, so it would be their
hmm
first contribution. So there would be that 5-year clock on before they can take that. Let's say they max it out and contribute $8,000 if they're over 50 for
hmm
2024. They have to wait 5 years until 2029 before they can take that money out. So the conversation went to, well, how confident are you that you're not going to retire in the next 5 years, because there's going to be a penalty if you touch the earnings on this, right?
hmm
Um, so that's just for, contributions. It's that one-time clock of 5 years, right? But the thing is, Roth conversions, Taylor, are getting more and more popular, where people are converting money from their pre-tax IRA to their Roth IRA. And the
hmm
caveat with that is each conversion you do has its own 5-year clock. So you have
hmm
to start tracking this stuff to make sure that you're not touching earnings within a 5-year period from a conversion that you made. So I know it's getting a little deep into the weeds. Maybe we can talk about that another time. But
hmm
there are a lot of nuances when you're talking about contributions, conversions to a Roth IRA, and the tax consequences associated with that.
hmm Yeah, just going off what you said, because I've had questions too before where somebody might be about to retire, but they might want to open up a Roth IRA to have that tax-free money. And just like you said, if they're expecting to need that within 5 years, probably not the best idea to go down that route.
Yeah.
So next we'll just get into the exceptions to the penalty, times you can take money from these two accounts and you avoid that 10%. So I'm going to go over the most common exceptions. The first one is that you can withdraw up to $10,000 for a first-time home purchase. If you need money to use for qualified education expenses, so tuition, books, room and board, that qualifies as an exception. If you become permanently disabled and you're no longer able to work, or you have a terminal illness, or if you pass, your family can withdraw money from the IRAs penalty-free. You can also withdraw up to $5,000 for birth and adoption expenses. You can make a withdrawal to pay for any healthcare costs if your out-of-pocket medical expenses are more than 7.5% of your adjusted gross income. So only the expenses over that 7.5% is going to be exempt.
Yep. And for listeners that want more information on adjusted gross income and modified adjusted gross income, I actually talked about this last week at episode number 240. So if you want to go back and kind of understand how AGI or adjusted gross income is calculated, go back and listen to episode 40 with that financial planning topic of the week at the end of the show.
Yeah, and the 7.5%, that's also going to be very similar to like the itemized deduction,
Yep.
where you can deduct those healthcare costs over that amount. A couple more common exceptions is you can withdraw money to cover any health insurance premiums if you're unemployed for at least 12 weeks. National Guard members and reservists can make withdrawals without penalties after 180 days of active duty. This next one, I think this is a newer addition or a newer exception. So if you're the victim of of domestic abuse by a spouse or a partner, you can take the lesser of $10,000 or 50% of the account penalty free.
Got it. Yeah, that's definitely a new one. Yeah.
And then the last, I think this one is pretty common as well, a 72T distribution. Essentially, what that means is that maybe you need 30 grand every year from your account to live off of. You would have to take that 30 grand for the greater of 5 years or until you turn 59 and a half, and that's going to be every single year. So you can't necessarily modify that amount, but it gives you access to the income from the account without paying that 10%.
Yeah, and I think, we have quite a bit of experience in this 72T, Taylor, because we work with individuals that retire early. And when we say retiring early, we're talking about before age 59 and a half, because that's when that 10% early withdrawal penalty goes away. So let's say, for example, you're 50 years old and you're comfortable with what you have and what you want to live off of with your retirement accounts. Maybe your house is paid off, you don't have any debt, and you're done working. So a lot of people come to us and they're like, hey, if I take money out of my IRA to live the way I want to live, is it really true that I'm going to have to pay ordinary taxes and a 10% penalty all the way up till age 59 and a half? And while it's kind of true, there is a way around it, and it's called these, 72T equal periodic distributions rule. Is that you tell the IRS, hey, I'm going to take out, like you said, Taylor, $30,000 each year up until I'm age 59 and a half. Then they're like, that's fine as long as you take $30,000 per year because the government's getting their tax revenue. That you're able to go ahead and do that so people can retire early without having any penalties from their account. However, if you go 1 year and you take $29,999 and not the $30,000 that was the stated agreed upon amount, then that's going to be a problem. And the IRS could go back several years and say, hey, all of the money you've taken out is now subject to the 10% penalty. So you do have to be really careful with that and make sure that you are taking the amounts you say you're going to take, because that would be a pretty quick thing an auditor could get a hold of and say, hey, now all of the money you've taken out over the past couple of years is subject to this 10% penalty. But it is a nice little workaround for people who don't have to work until age 59 and a half.
Yeah, I think it's a great option, but like you said, there's a couple downsides if you're not careful and really keeping track of what you're taking out.
Yeah, a couple of gotchas in there, just kind of like everything else with the tax code, unfortunately. But well, thanks, Taylor, for giving us some great info on that. I know that that's usually a pretty big talking point with clients and prospective clients when we're talking about retirement or within a couple of years of retirement. So hopefully people got a lot out of that. Well, that's it for us this week. Just want to remind people that if anyone wants to create their own podcast, please use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth, all lowercase and no spaces. Thanks everybody for listening to episode 241 of the Independent Advisors Podcast. We will be back with you next week for episode 242.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.